Hello, everyone, and welcome to today's SCORE Fairfield County's live webinar on what to consider when buying a small business. I'm Bob Hogan, the webinar coordinator today, and a business mentor here at SCORE Fairfield County. I'm going to be your host today, and our presenter, who you can see in the screen here, is Cliff Ennico. More on Cliff in just a minute, but first, some brief information on SCORE. SCORE is a nonprofit national partner of the SBA, and Cliff, if I could ask you to move the slide. Locally here in SCORE Fairfield County, we have over 130 volunteers with a wide range of industry, process, and subject matter expertise. And we offer three primary value-added services to small business owners. First of all, we offer free one-on-one counseling by face-to-face, but in these times via video. And you can also do it by telephone or email. And if you'd like to take advantage of that, you can access it by clicking on the yellow bit.ly link that you see on the screen. Or you can go to our website and request a mentor link in our website, fairfieldcounty.score.org. We also offer a wide range of educational workshops and webinars like the one today, about roughly 150 throughout the year. And lastly, we have extensive resources on our website where you can also get access to subject matter experts as needed. Our next live webinar will be tomorrow, Wednesday, February 10th at noon, and the topic is Digital Marketing Strategy for 2021 and Beyond, with Susan Catalano and Robert Clark presenting. And you can find more specifics again on our website, fairfieldcounty.score.org. And when you're also on our website, we also carry on the website a wide range of on-demand webinars that you can access at your leisure. Just some logistics today. We have set aside time for Q&A at the end of Cliff's remarks, and you can, however, type your question in at any time using the chat feature, and you can access the chat feature by hovering on the bottom of your screen and just clicking that chat button. We will end our webinar sharply at 1 o'clock to respect your time. We are recording the webinar, and a link to the recording will be available on our website within the next 48 hours or so. So it's now my pleasure to introduce our speaker today, Cliff Ennico. Cliff is a nationally recognized small business, legal, and tax expert, and is best known as the former host of Money Hunt on PBS, where entrepreneurs defended their business plans before America's toughest panel of experts. An attorney and small business consultant here based in Fairfield, Connecticut, he has helped launch over 15,000 businesses. He is the author of 16 books, most recently, the Crowdfunding Handbook, How to Raise Capital for Your Business Using Equity Portals. Cliff, it's all yours.
Hey, thanks, Bob. And thank you very much for that wonderful introduction. Those of you who know me, of course, know that the one word that should have jumped out at you from Bob's introduction is I am a lawyer by training. And this proves that I am a lawyer, this slide right now. We always tell you what we're not going to do before we tell you what we are going to do. But there's some very important stuff in here. The most important thing really is that while we are going to get into some legal and tax stuff in this presentation, there's a very big difference between giving legal advice and giving out just general information. This is what the law is all about. That's general information. That's what we're doing today. Here's what you should do, Bob and Elliot. This is why you should do something different. That's advice. I'm not really in a position to give one-on-one advice in a program like this. I'm certainly happy to answer any questions that you may have. And if you do have a need for one-on-one consulting, I'm happy to speak to anyone after this call is over. Just send me an email or leave me a phone message, and I will get back to you as soon as I can. So let's get going here. A lot of people are buying and selling businesses these days. Last year, during the pandemic, during the lockdowns, I thought I'd be sitting around reading magazines all year, and I was very pleasantly surprised. I actually had one of the busiest years last year that I've ever had, and a lot of it has been on the M&A front, merger and acquisition, buying and selling small businesses. In any given year, I probably do 5 or 6 of these. Last year, I did a dozen. And I'm expecting so far year to date, I've got about 8 or 9 that I'm working on right now. Why should you consider buying a business? And by the way, this is the first part of a 2-part program. The second part, which is things to think about before you sell a business, is going to be on March the 2nd. Wednesday, March the 2nd. So block out your, I'm sorry, Tuesday, March the 2nd. So block out your calendar. Now, for those of you who are looking to sell a business, that's the program for you. This is the program for people who are looking to buy a business. Why buy a business as opposed to starting one from scratch? Well, it's usually less risky than starting a business from scratch. First of all, you don't have to worry if it's a brick and mortar business. You don't have to worry about where to put the bloody thing. It's already there. And hopefully it has customers already. You will have revenue from day one. You know, the day after you close, you walk in the morning and there will be customers there, which is not the case when you're starting a business from scratch. You have to work to generate those first few customers. You don't have to do that when you're buying an existing business. They're already there and hopefully they'll stay with you. You can kick the tires and see how it's performed in the past. This business has an operating history. So you can, kick the tires. You can meet some of the key clients. You can review the business's financial statements going back 3 to 5 years and figure out what the story has been. How has this business been impacted by COVID? Very important thing to look at right now. So that's another good thing is you're not going in blind. You kind of know how this business has been performing and hopefully it'll continue to perform that way. And then also the sellers usually in a deal like this will stick around for a while and help you with the transition. They're not just going to disappear, and you want them to stick around, especially if it's a service business or a professional practice. You want to know that those key clients are going to come over with you, and it won't happen unless the seller, participates in some way and helps you make introductions, meet with them, tell the clients, hey, look, there's this guy, Cliff Ennico, who's buying the business and he's okay. He doesn't have a criminal record or anything like that. I really like him. That really helps a lot in maintaining client attrition and keeping client attrition to a minimum. That's something we're going to talk a lot about in this program because it's a very important thing when you're buying a service business. But it's not all beer and Skittles. There are some disadvantages. I mean, it's still pretty risky, but either starting or buying any kind of small business carries a certain amount of risk, and you can't really eliminate it. There may be a good reason why the business is for sale, and the sellers are not obligated always to disclose, future risks that they see on the horizon. They are obligated to give you fair and accurate information about how the business has performed, but if they know something, that you don't know, they're not always obligated to tell you about it the way it would be in a house closing, for example. Financial statements are wonderful things, but they all have a common problem in that they're historical. When you look at a financial statement of any kind, balance sheet, income statement, cash flow statement, you are looking at the past. You are looking at how the business has performed. The past may not be prologue to the future. There may be things that are going to impact this business that are coming down the pike that are not reflected in those financial statements. And sometimes you get a nasty surprise. And we'll talk specifically about what you do when you do diligence on a business. Employees and customers might not be loyal to you. When you buy an existing business, small businesses tend to be kind of like families in a way, and people get very close. They become like families. So when an owner sells out, to a stranger, especially the employees, and especially if there are key employees that are customer facing, may not like this all too much, and they may bolt to another employer. Or they may follow the seller. If the seller's going to another state, they may follow that seller. There's a possibility of that. The other thing is customers too. We all get attached to our doctors. I have been told this. I've not independently confirmed it, but I have spoken that when a doctor, a family physician, retires and sells his practice or her practice to another doctor, the attrition rate of patients is somewhere around 50% within the first year. Half the patients go to other doctors. If you had a doctor who retired, did you stay with that doctor or did you go to another doctor? Chances are 1 in 2 that you probably went with another doctor. So attrition rates, especially in businesses where there's a lot of personal contact with the customer and you develop a personal relationship, can be very great. Also, the seller is not legally obligated. If you buy a house in Connecticut, for example, and there's termite damage or there's a history of termite damage, the seller is required by law to disclose that. In a business sale, the seller is not obligated to disclose flaws. It is very much a case of buyer beware. So So let's begin. So let's say now you decide you want to buy a business. Where do you look? Where do you find businesses for sale? Well, there are some published sources, and they vary a lot in quality and reliability. There are newspapers. So, for example, if those of you who get the New York Times, if you look at the Sunday Fairfield County section or the regional section, in the back, there's a listing of businesses that are for sale there. There are also shoppers. You can get these usually at your local gas stations. That this is the place where people are advertising exercise equipment for sale and that kind of stuff. And in the back, there's sometimes ads for businesses that are up for sale. Tend not to be very reliable, but don't overlook them. There are some online sites that are focused on helping you find businesses for sale. Biz Buy Sell, BizQuest, these are two of the big ones. If you're looking to buy a franchise business, Franchise Gator is a website that lists franchises for sale, both new territories and existing territories. Entrepreneur Magazine also does the same thing at entrepreneur.com. Frankly, though, they're not very reliable and they're very scattergun. I'll be very honest with you. This is the mass market approach to trying to buy a business. If you're really looking to buy a business in a community, something you might want to consider doing is taking out a looking to buy ad in one of your local newspapers or your local media. Hey, I'm new in town and I'm looking to buy a bagel shop. That might get you some attention. People actually do look at those sometimes. Consider it. Don't spend a lot of money on it, though. Let's talk about business brokers now. I confess that I have a very particular bias when it comes to business brokers. In my experience, and I keep in mind I represent both sellers and buyers, business brokers tend to be a last resort. Most people who are looking to buy a business try to do it themselves until they get desperate. And the reason for this is business brokers' fees tend to be very high. They're often as high as 10, 15, 20% of the purchase price. So a lot of sellers try to do a FISBO, for sale by owner, before they engage a broker. So by the time a broker gets involved, the sellers are desperate to sell, and the business usually has some issues. This dog has fleas on it. And you got to be very careful. Now, that's my experience with business brokers, but not all brokers. Franchise brokers are an exception. When somebody with a franchise business is looking to sell, they obviously talk to the franchise first, but the next thing they do is they call a franchise broker. And there are some organizations of franchise brokers that are very reliable, and they tend to have a lot of the best deals. Frannet.com, the franchise network, has representatives all around the country, including New York and Connecticut. If you're looking to buy a franchise specifically or a franchise business, you may want to talk to a franchise broker before you start using Franchise Gator or contacting individual franchises. But that's an exception. Business brokers are usually not the best place to go to look for businesses. And keep in mind also, they are representing the seller, not the buyer. They're not going to be looking out for your interests. Although a good business broker will help you with financing options. They will point out, they usually know the local SBA lenders. They can help you get a Section 7 loan. Of course, your score counselor can do the same thing. But they maybe have some other creative financing options that they can introduce you to. For web-based businesses, there are some very good online brokers that deal with. And frankly, I've dealt with both of these. FE International is actually based in London, England, but they have a branch in Boston, and they deal with e-commerce businesses mostly in just about every space that you can consider. Then there's also an organization, these guys are in Florida, Website Closers, that specialize in web-based businesses. Now, they're not selling domain names. They're actually selling e-commerce businesses that have traffic. So if you're looking for businesses like that, these are two brokers organizations that you may want to check about. But frankly, the best way to find a business is really to ask around. The best businesses to buy are those that aren't looking to sell. It's a little bit like high school. I hate to say this, but when you wanted to attract yourself to certain other people, you often played hard to get. And that's the same kind of in this world as well. It's a little bit like dating in high school a little bit. bit. A lot of small businesses owners are thinking about selling someday, but they're not really in the market yet. So when you walk into a local bagel shop and you say, hey, you know what? I'm new in town here. I'm thinking about buying a bagel shop. If you know of any bagel shops that are available for sale, I guess you guys talk to each other. Let me know. I may be interested. That will get the owners thinking, maybe it's time for us to sell. The kids are all grown up. They're all doctors and lawyers. They don't want to run a bagel shop anymore. So maybe this is nature's way of telling us, that it's time to sell. We have a motivated buyer here. Let's give it some thought. Maybe it's time to sell out and move to Florida or someplace like that. Your score counselor is a good place to look because they hear about businesses that are up for sale or business owners who are just struggling and just are getting to the point now where they're getting ready to sell. Landlords and their agents. What do I mean by that? Well, I don't mean real estate brokers. In my experience, a lot of landlords that own strip malls appoint one of the tenants to act as sort of their agent and field questions and problems and issues from the other tenants in the strip mall. So if you can find that person, they will usually know, hey, the liquor store next to me, he's been complaining a lot lately. He's getting old. He's getting up there. Maybe you should talk to him about potentially selling. They'll have that kind of inside baseball. Be careful, though. I mean, a lot of landlords right now are having tenants that are struggling, and I'm sure they'll be happy to say, well, why don't you talk to these guys? But I'm not so sure you really want to buy into a business that's 6 months behind on its rent. That's something your lawyer's going to have a little problem with that. Maybe accountants and lawyers. I mean, this is part of the common wisdom here that accountants and lawyers are good places to go to find businesses for sale. I frankly doubt that wisdom, to be honest with you. As a lawyer myself, I sometimes get calls from people that are looking to buy specific businesses, but unless I know the person very well, I'm very leery to recommend them or to sell them to one of my existing clients. I'm very concerned about my reputation here. If I introduce one of my clients to someone who turns out to be a Yahoo, well, they're going to think that I'm a Yahoo as well. So keep that in mind when dealing with it. I mean, don't get me wrong. By all means, send a form letter to a bunch of local accounting firms and say, hey, if any of you guys are have a client in this industry, I'm thinking of buying. By all means do it, but don't expect a massive response. Most accountants and lawyers are very protective of their reputations and their relationships with clients, and they're not going to introduce a total stranger to someone that they've been working with for 10 or 15, 20 years. Other people may have different experiences, but that's just my experience. Also, too, franchises. If you are looking to buy a Dunkin' Donuts franchise, the best place to look is Dunkin' Donuts. Call their corporate headquarters. Most franchises have lists of franchisees that have expressed an interest in selling out or that are coming up for expiration of their franchise term and have indicated that they're probably going to retire at the end of that. Most franchises have records of that, and they can help make introductions for you. Okay, is this the right business for you? I mean, that's a question you should be asking, when you start a business too, but it becomes especially important when you're buying an existing business. Keep in mind, you're going to have customers from day one, which means you're going to be working pretty hard, the minute. There aren't going to be a whole lot of down days when you buy a business, at least, not early on. Will this business give you the lifestyle you want? I mean, some businesses are more profitable than others. Whenever you know yourself, sometimes you go into a local fast food place and all of the employees kind of look the same. And there's a reason for that, because they're all related to each other. This is a family business that's getting by and scraping by because they don't have to pay family members minimum wage. That is not a business that is probably right for you if you're looking to build a retirement income. Will this business, how profitable is this business? We'll talk specifically later about how you do diligence with this. Will you enjoy the work? Will you enjoy the work? Do you care about the customers? This is something. It's one of the more profound things I've learned, folks, in 40 years of working with small businesses and their owners. The most successful people are people who truly care about their customers and who know their customers and who know the issues that they're facing, their fears and passions. Some of you have listened to my YouTube videos. I talk a lot about this. If you really don't like your customers, if you really don't care about them, if you don't care enough to at least empathize with them and find out what their issues are and what problems they're facing in life, it's really going to be hard to successful running any kind of a small business. But that's a bigger topic than today. Um, think about your skill set. How much of a learning curve will you need? If you have never run a restaurant or an ice cream shop before, I mean, all right, you like ice cream. I do too. But does that mean that, what's it going to be like to make sure that all of those 50 flavors are fresh and up to date and, ready to be scooped, on a given day? How much of a learning curve will you need? Beware the absentee owner sales pitch, especially with franchise business. A lot of franchise brokers like to say, hey, hey, yeah, this is kind of a grungy business, but don't worry, you're not going to be the one who's going to have to go in and change the oil every day. You're going to be managing those people. You're going to be an absentee owner, and they're the ones who get to get their hands dirty. Well, guess what? That doesn't always work. I always tell people, if you buy a muffler shop or something like that, and your manager calls in sick one day, well, someone's got to go in and service those cars and get under the cars and get dirty. And it may be you. If you're the kind of person who does not like getting their hands dirty, do not buy a muffler franchise. It's as simple as that. I mean, I have had clients get called off of cruise ships and helicoptered back to the United States because the manager running their franchise broke his ankle skiing or something like that. I've had that happen to clients of mine. You always have to be prepared to get behind the counter and do the job yourself, even though it's something you hope you won't be doing every day. Can you do a better job than the current owner? If the business is struggling, is it because the owner is just tired? Is it because, they just need some younger blood in there with some fresh ideas? Or is it because the business is going to hell because of things that the owners just can't control? That's a major piece of your due diligence. Are you comfortable with selling? Make no mistake. Those of you who are familiar with my YouTube videos, this is one of my mantras. If you are a downsized corporate executive and you're thinking about buying a small business because you think it's cool and you want everybody to love you, it's all about selling. You have to get comfortable with selling because you will do it every hour of every day. Marketing is key to success in a small business. If you do not know how to market, if you do not like marketing, you're going to have a problem. For those of you who are new to selling, check out my YouTube video. If you search on YouTube for Cliff Ennico, how to sell, I have a video with almost 300,000 views from people in 45 countries on how to sell just about anything to just about anybody. It's a great place to start. It's only an hour out of your life, and it's a lot more entertaining than some of the reality TV shows that I'm seeing these days. So there's my little pitch for my YouTube channel. If you go to youtube.com and search for Cliff Ennico, you'll see I've got over 40 one-hour videos, many of them score presentations that I've done over the years on just about every aspect of running a small business. Think about location when you buy a business. This is something I feel very strongly about. Never buy a brick and mortar business that is more than 10 to 15 miles from where you live unless you plan to move there. It is very difficult to run a small business if you are not a member of that community. It is extremely hard. Are you committed to being part of the community? I mean, I will share with you, if you live in Westport, Connecticut, and you're thinking about buying a business in West Hartford in upstate Connecticut, upstate Connecticut is very, very different than Fairfield County near the New York line. The culture is very different. People think differently up there. You're much more in New England than you are here in Fairfield County. Fairfield County really isn't New England. It's part of the New York City exurbs. It's a different way of looking at life. What works in Westport will not necessarily work in West Hartford, and vice versa. And also too, you're saddling yourself with a huge commute. As someone who commuted to work over 2 hours every day for several years of his life, it's very hard to run a business when you have to factor in a 1 or 2 hour commute every day on top of running the business and doing what you have to do. If it's a brick and mortar business, if it's an online business, of course you can run that anywhere. But if it's a brick and mortar business, if you're thinking about buying a business in a community that you don't know, get an advisor, an accountant or lawyer who lives in that community and who knows the local knowledge about what's going on there in that community. Because there may be things going on in the community community. And as an outsider, you are not aware of what those things are. And they could have some nasty surprises when you buy the business. Okay. So you found a business you want to buy. The first thing you want to do is you want to negotiate the purchase price. The first step in buying a business is to prepare a non-binding letter of intent, or LOI. These are sometimes called a memo of understanding, MOU, exactly the same thing. Basically, it's an informal, non-binding document that says, hey, I'm making you an offer to buy the business. Here's what I'm willing to pay as the purchase price, so much upfront, so much, with interest over 3 to 5 years. And here are some of the things that I need to get, in the paperwork. This will save a lot of money in legal fees later on. I love it when a client who's buying a business gives me like a 3 or 4 page term sheet where a lot of the business points have already been nailed down. Now, it's non-binding, but that helps me a lot in drafting documents. If I only have to do one draft of the document and the other side just comes back with a couple of comments, that's not going to be a big legal bill. If I'm trying to negotiate the business deal and the legal documents at the same time, that's when you go through multiple drafts of documents and legal fees get very expensive. So to keep legal and accounting fees down, try to negotiate as much of the business terms with the seller as you can up front. Even though it's non-binding, it's very difficult for a seller to totally change his mind and do a 180, after he or she has committed to a non-binding LOI. The purchase price, there are a million ways to calculate the purchase price of a business. I could do an entire seminar on this topic alone. Small business valuation is more of an art than a science. Usually the price is based upon a multiple of either the gross sales of the business, or the pre-tax earnings, the earnings before income tax, or EBIT. Those are the two ways to value a business. It's usually not done based on just the last year. Generally, what you do is you look at sales or EBIT over the last 3 to 5 years, and you do an average, a weighted average of those to come up with what a decent purchase price would be. And the reason for that is because year to year, business performance tends to fluctuate. So for example, last year, 2020, was a really lousy year for a lot of small businesses. So most sellers are not going to want to base their purchase price on last year's sales or pre-tax earnings because they were miserable, and they're going to get a low ball price. So what you want to do is you want to average back. A 3 to 5 year look back is common, and you do an average of these, and then you apply a multiple to that to come up, which is usually between 1 and 3 times. Usually, I mean, very rarely will it be outside those parameters for a basic retail or service business. So for example, you look back 5 years at the pre-tax earnings. The average annual pre-tax earnings, including last year, is $100,000. You then apply a multiple of 2.5, and then the purchase price is $250,000. The math is really very simple. Coming up with the comparable, though, is a little tricky. Is it, what the question you have to ask? How do you pick the multiplier? How do you pick the 1, the 2, or the 3, or whatever? The answer is you got to look at other similar businesses and what have sold. And this is the one area where business and franchise brokers add their value, because they tend to know what other similar businesses have sold for in the community. This is very difficult information to get online. There are some online databases, but they tend not to be granular enough. You want to know, if I'm buying a deli in Westport, when were the last 5 delis sold in Westport, and what was the purchase price for each of those deals? It's very hard to get that information online. The brokers that's where they add their value, is in helping you price, come up with the right purchase price, because they have access to non-public databases and stuff where they can get that information. When you're negotiating the purchase price, look at what we call ODI, owner's discretionary income. This is not something you will find on a financial statement. It basically means how much are the owners taking out of the business to live on? How much, after they pay the expenses of the business, the rent, the payroll, whatever, how much is left over for them to live on? You want to know that number. Now, it's not in the financial statements, but a good accountant can help you ferret out that information from the financial statements. And generally, you want to be sure that you can cover the purchase price in 1 to 3 years from the ODI. So if you're paying $250,000 for a business and the ODI is $100,000, you will be able to recoup your purchase price, without interest, of course, in 2.5 years. The math again is very simple here. If the ODI is 50,000 and the seller is asking 300,000, well, then it's going to take you 6 years to recoup your purchase price, and that's a riskier proposition. A lot can happen to a business in 6 years that won't happen in a year or two. So, and so basically, and the other thing about negotiating the purchase price, if the business is iffy by any way. So let's say, for example, it is in an industry that is not really robust right now. It's a brick and mortar boutique or something. Amazon is eating up that entire space. You're not really sure what the future of the business is going to be. Hold back a portion of the purchase price. Don't pay it all up front at the closing. When you're negotiating the purchase price, it's not just a number, it's also a timing factor. When does the purchase price get paid? How much gets paid up front? How much gets deferred? How much is contingent upon future events? A good attorney can help you to put in a holdback clause in the LOI that will basically say, okay, it's a $200,000 deal. I'll pay $100,000 up front, but I'm going to wait 6 months before I pay the second 100,000. And if business falls off by more than a certain percentage, that second portion of the purchase price will be reduced accordingly. That's called a holdback, and it could be a very good thing for you if you're buying a business whose future is uncertain. Okay, let's talk about financing. Where do you get money to buy a business? Well, a lot of sellers are willing to take back paper. They're willing to defer a portion of the purchase price over time. Generally, in these deals, it's usually somewhere around 10 to 30% of the purchase price that they're willing to defer, with a 2 or 3 year payout at 5%, 6% per annum. That's what's kind of market right now. That could change next year. Just beware here. A lot of people like to use SBA loans, and of course, the SCORE people will help you get an SBA loan, what we call a Section 7 loan. But there's a new rule that's come into effect recently now, where if the seller is taking back paper, the SBA will not want that person to get paid until they get paid. Now, it always was the case that when the seller was financing the deal with a promissory note, the SBA always wanted them to subordinate their lien to the SBA loan, so that if the business went under, the SBA would get their money back before the seller would get anything. That's always been the case. But what's going on now is they want a subordination of payment, where the SBA loan gets paid off completely, and then the seller's note kicks in. Now, that's new, and a lot of sellers are going to balk at that. Now, there are ways to get around that, which a good attorney will help you with, and which I can't really talk about on this program. But just be aware that if you're using SBA financing, the minute the seller hears that, they're going to want to get as much of their money up front as possible, because they don't want to have to wait 3, 5, or even 10 years to get a payment. Royalty financing. This is sometimes called bootstrapping, or an earn in or an earn out. But basically what happens is you pay a certain amount at the closing, but then the rest of the purchase price is based as a percentage of gross revenue, net revenue, or pre-tax earnings before income tax, EBIT, for a specified period in lieu of interest. In other words, you don't pay interest on the balance. What you do is you pay the seller X% of gross revenue, let's say, up until it reaches a certain amount, and then the purchase price has been paid in full. So, for example, a royalty financing will look like this: $100,000 at the closing, plus 5% of gross revenue each month for 2 years, up to a maximum of $150,000. So the total purchase price is $250,000. I always insist, whenever a client of mine is looking to do a royalty deal, it should always be based on the business's revenue, not profit. If you base a royalty payment on profit, there's too many ways that the seller, or that the, I'm sorry, that the buyer, the seller's going to object to that, because the buyer, there's just too many ways that the buyer can play around with that. So for example, the buyer could give themselves a huge Christmas or year-end bonus, which would wipe out the profit for the year, the net profit for the year, and the seller's got to sit in his hands and wait another year to get money. Most sellers are not going to agree to that. When you do a royalty deal, it should really be based upon gross revenue. The last thing I want to talk about here, I could do another whole program on this, and this is especially true when you're buying franchise businesses, is the rollover as business startup, the ROBS. It's very common in franchise purchases. Basically, this is where you have a big 401k from a former employer and you want to use that to buy the business. What you do is you create a C corporation with a profit sharing plan, and you roll part of your 401k over into the profit sharing plan. The profit sharing plan buys the shares of the C Corp, and that's how you get the money into the C Corp, which then uses it to pay the down payment for the business. It's very common in franchise purchases. Be careful. Do not do this yourself. The IRS has very strict rules about these. They do not like the ROBS. Look at that acronym, ROBS, as in these transactions rob the treasuries of revenue, the treasury of revenue. The IRS does not like these deals. If they're not structured very carefully, you could find yourself with an audit trigger that would trigger an IRS audit. These are some companies there are companies out there that do these for a living. Benetrends.com is kind of the gold standard. There's also Guidant Financial and FranFund.com. These are companies that will help you do your ROBS and make sure that they get a letter from the IRS saying that everything is okay, so you don't end up with a tax problem down the road. And keep in mind that when you do one of these, you're putting your retirement income at risk by investing in this small business. If this business doesn't work out, you may be working well into your retirement years scooping ice cream somewhere. Okay. There are two ways to buy a business legally. You either buy the assets of the business or you buy the stock of the business. And there are pros and cons to doing it each way. Generally, if you are a purchaser, you want to buy the assets of the business and not the stock. Why? Because when you buy the assets, you do not assume all of the seller's liabilities. You only assume, you can cherry pick. You can assume some liabilities that you like, but you can reject others. So for example, if the business has a great location, you definitely want to assume their lease, the seller's lease. But if the seller has gambling debts, you certainly don't want to assume those. So buying the asset means you can get the lease, but not the gambling debts. Okay. You also get a step up in basis for tax purposes. What that means is that when you buy the assets of a business, the basis is whatever you paid for those assets. So that means when you go to sell the business later on, you will only be taxed on the delta, the difference between what that buyer is paying and your basis, which is what you paid your seller for the business. The downside is you have to form a new business here. You're really not acquiring the same business. You have to form a new corporation, LLC. You have to get a new EIN. You have to get a new bank account. And then that company goes and buys the assets of the seller. So you're starting a new business, and that could be a problem. If the business has been around for 30 years, if it has an incredible credit history with banks and all that kind of stuff, all of that goes away when you buy the assets of a business. You're essentially starting a new business from scratch, but you're getting your assets from somewhere else. Buying stock is the other way to buy a business, not as beneficial for the purchaser, but you may have to do it that way because there's no other way to do it. When you buy the stock of a business, you assume all assets and liabilities of the business. You're buying the entire balance sheet, including things that you don't know about and that the seller does not disclose to you. You also get a carryover basis, which is the same as the seller's. Now, what that means is, let's say the seller started the business. When they started the business, the basis was zero. Now they're selling it to you for 250. You then you run the business for 5 years and you sell it for $500,000. If you buy the stock of the business, you will have to pay taxes. When you sell the business later on, you're going to have to pay taxes on $500,000. Whereas if you bought the assets of the business, you only have to pay taxes on $250,000, the appreciation between the time you bought it and the time you sold it. That's the tax advantage of buying assets rather than buying stock. Now, if you're a purchaser, you want to buy stock, but there may be situations where you can't. So, for example, if the business has a government license or another, so for example, let's say you're buying a store that sells medical equipment, crutches and what the things that old people use, those rollerboard things the walkers and stuff like that. You generally have to have a license from Medicare or Medicaid to be able to sell equipment and get reimbursed from those agencies. Medicare and Medicaid licenses are not transferable. You cannot sell those to a new company, which means you cannot sell the assets of the business. Another little trap for the unwary: businesses that have eBay or Amazon accounts. A lot of people don't know this. eBay and Amazon do not allow their sellers to transfer their account to another person. And the reason is because of the feedback scores. The feeling is that if somebody with 100,000 feedback score of positive transactions is selling out to a newbie who doesn't know what they're doing, that feedback score is fraudulent. Basically, they're not buying the same business that the seller had. That's the theory behind it. I personally don't agree with it, to be honest with you. I've been lobbying eBay and Amazon for years to change this. So if you have a client that's buying, or if you're buying an eBay or Amazon business, be aware that you may be able to acquire the account, but the feedback score is going to ratchet to zero. And that's going to impact the purchase price that you are willing to pay. Another thing too about buying stock is, let's say you are buying a business that has a 30-year credit history where you want to keep the EIN and all that stuff the same, because they have a million vendors and that EIN is on all the vendor accounts, and it's a pain in the ass to change all of that. Buying stock will avoid that. It's considered a continuation of the same business, and you can use the same EIN. The purchase and sale agreement, this is something you're going to use a lawyer to do. So we're not going to spend a lot of time on this. Your lawyer sweats this more than you do. The one lesson I want to say here is, and this is something based on 40 years experience, in my experience, as long as the purchaser and the seller communicate, very rarely in these deals will there be problems between the two of them. Where there often are problems in these deals is with third parties over whom we have no control. The seller and the buyer have no control. So for example, if you are buying a brick and mortar business, the landlord will almost certainly have to consent to the transfer. And some landlords are more reasonable than others. I've had deals fall apart because the landlord simply just didn't like the buyer. They met the buyer, they didn't like him, didn't think they were a good credit risk, just didn't like their personality, and they unreasonably withheld their consent to the transfer, and the deal died. I've had that situation happen to me. Franchisors, if you are buying a franchise business, the franchise must approve you as a potential franchisee. You have to meet all the same criteria that you would meet if you were buying an existing business, although you don't have to pay the full franchise fee. You usually pay a much smaller amount called a transfer fee. If the seller has a bank loan outstanding and owes money, that bank is going to want that loan paid off before they will allow the transfer to happen, because they have a lien on all the business assets. So that loan has to be dealt with. Either you're going to assume that bank loan or it's going to get paid off at closing. Equipment leasing companies also, if a seller has equipment leases, most equipment leases have due on sale clauses, where if the lessee sells the business, that whatever the balance is due under the lease becomes due and payable right then and there. And most leasing companies are real SOBs. They will not negotiate those due on sale clauses. So that's one thing you have to focus on. It's very common to pay a deposit upon signing the asset purchase and sale agreement. Usually it's 5 to 10% of the purchase price. There will be a provision in there that will be very specific, saying under what circumstances does that deposit go to the seller, under what circumstances does it go to the buyer. Make sure that your attorney holds it in their trust account, or the other attorney. There are a million rules relating to lawyers' trust account. Lawyers just can't play with this money. It's your money, not theirs, and there are very specific rules, and they go to jail if they violate those rules. So you want the deposit to be held by an attorney in their trust account. Never give the deposit to the seller for their own, because they are not subject to those rules. They can just take the money and go to Vegas, and they cannot do a thing about that. Okay. Other things to think about: the seller's non-compete clause. especially in an asset sale, but even in a stock sale too. You want this, you don't want to buy a business and then find out that the seller is going across the street and running a similar business. You don't want that. Very customary, 2 to 5 years is a typical term. The time limit and the geographic restriction must be reasonable. So if you are buying a local little boutique business, a non-compete that says that the seller will not operate a similar boutique anywhere within the United States is probably not going to be upheld by a court. A non-compete that says that the seller will not operate a similar boutique within Fairfield County or within a 25-mile radius is much more likely to be enforced. A non-compete cannot deny somebody a living, and courts, especially in the northeastern United States, do not like non-competes at all. So you got to draft them very carefully or have your attorney do it to make sure that they have at least a chance of being enforceable. The survival clause is another little thing you have to watch out for when you negotiate a purchase and sale agreement. This is a clause that's buried at the end of the agreement, and a lot of people overlook it, but it's very important. This is a private statute of limitations. So let's say you're buying the stock of a business, and the purchase and sale agreement has a million representations and warranties about the business and how it's been run and all of this. If the survival clause is only 3 months, what that means is if anything goes wrong and you want to sue the seller because they breached one of those representations and warranties, you must do it within 3 months of the closing, or else you are no longer able to sue the seller. It's like a statute of limitations. You want, as a buyer, you want the statute of limitations to be as long as possible, a year, 2 years, sometimes even 3 years. A 6-month statute of limitations was not going to give you enough time to run the business and find out where the bodies are buried. Talking about, so now you've done the LOI, you've negotiated the purchase price, you've negotiated the purchase and sale agreement. Now you have to do diligence. Okay. And there are different types of due diligence. There's operational due diligence. What are the area demographics? Do they favor the business? Remember what I said earlier, a seller is not obligated to disclose future risks. They're not obligated to do that. So you're the one who's got to figure this out. Is the population changing? Is everybody moving to Florida? Is the population aging in place, or are a lot of young people moving in from New York to Connecticut, for example, which is happening a lot in Fairfield County right now? I'm not saying any of these things are good and bad, but they are going to impact the performance of the business. If you have a senior care business in town A, and town A's demographics are changing and a lot of younger people are moving in, well, that's not really a great place for a senior care business. In a town like that, you want to be doing something like an educational, bookstore or toy store or something like that. That's a much better business for that demographic area. How are the laws changing in the area? Is the zoning board going to change the zoning of the town in such a way that that it impacts the business and the business cannot legally operate? What's going on with traffic? Is the state going to be doing major infrastructure repair and they're going to shut the street down in front of the store for 3 years? I mean, I've had situations where clients have done that. They bought a business, without counsel, and the next thing they know, there's no traffic because the street's been shut down for 3 years for repairs. That can happen. If you're buying a business in a store, again, in a location that you don't know, hang out there. Go there every day. Watch what happens. When are they busy? When are they not so busy? Do the employees seem happy? Also, are there key employees who have bonded with customers and must stay on board? If you're a lawyer and you are buying a law firm, the receptionist is the most important person in that law firm, because they know all the clients, they know where all the bodies are buried, they know where all the difficult files are. You want to make sure that person hangs around for at least a year or two after you buy the business so that you can understand what's going on. One of the biggest mistakes doctors make when they buy a new practice is they fire all the existing employees, the staff, and they bring on their family members. That is the dumbest thing to do in the world, because those staff knows the patients better than the doctors do. In a lot of cases, when you go to your doctor's office, you sometimes have a better relationship with the receptionist or with the nurse than you do with the doctor. Firing those people is a very, very bad mistake. Financial due diligence: you should review the last 3 years' income, payroll, and sales tax returns. Bottom line here, folks, when you're buying a small business of any kind, you need a good lawyer and a good accountant. You need both of them because we tend to look at different things. The accountants tear apart the tax returns and look to see where the bodies are buried. The attorneys look at the contracts and see, can they get out of them? Are they assignable? Are you going to lose a key asset when you buy the business because the contract doesn't allow it to be sold, like the due on sale clause in an equipment lease? You need both. Do not try to buy a business without a good accountant and a good lawyer. You need both of those people. A couple of things about taxes here. If you are buying the assets, keep in mind that you have to allocate the purchase price to different asset categories. When you buy a business, the assets of a business, you're buying assets that depreciate at different rates. And the IRS has a form 8594 they want you to file that says how much of the purchase price was for equipment, how much for inventory, how much for supplies, how much for the seller's non-compete covenant. And the IRS doesn't really care how you do it, but they want to make sure the seller and the buyer file the exact same form when they file their taxes for the year. If the seller tells one story and the buyer tells another story, that's an automatic IRS audit, and you want to avoid it. Also, watch out for sales and use taxes. This is a trap for the unwary, especially in the Northeast. New York has a bulk sales law, which means that even if you are buying a business that has never paid sales tax to the state of New York, you have to pay a one-time sales tax on the portion of the purchase price that is allocated to equipment and depreciable property. So if you are buying a business for $100,000 and $10,000 of that purchase price is allocated to equipment, you're going to have to pay something like $800-900 in sales tax to the state of New York, even though the business was not subject to sales tax previously. That's a little trap for the unwary. In Connecticut, we have something called, and other states too, by the way, some of the southern states have this too. They have transferee liability, which means that if you buy a business and the seller owed sales tax on the date of closing, that becomes your responsibility and you have to pay it, even though you didn't specifically assume the sales tax liability. In Connecticut, you have to get a clearance letter from the Department of Revenue Services saying specifically, okay, we've looked at the books and records, you're okay here. You will not have liability for the seller's sales tax liability. It's currently taking about 3 to 6 months to get that clearance certificate. Okay, here's a couple of things about buying a web-based business. Again, use one of the brokers here because the brokers here are very helpful. What you want to worship here are the traffic numbers. That's the most important thing about buying a web-based business. Look at their traffic numbers, do screenshots, attach them to the purchase and sale agreement, and then do a holdback in case the traffic falls off after you buy. This is very typical of e-commerce businesses. You buy an e-commerce business, they have a Google ranking of whatever, and then a month after the closing, they do a Google dance where Google changes its algorithms, and instead of being 10th in a Google search ranking of 10, they now have a search ranking of 100,000. Meaning that they're buried in the pack. Do not buy a web-based business unless you have SEO or internet marketing skills. So if that happens to you, you can build the traffic. You know how to build the traffic back up. So summary, buying a business is less risky than starting one from scratch, but it's still pretty risky. Look for a business to buy before it goes up for sale. Don't wait. A business that's been listed for a long time probably has a lot of issues that you don't want to deal with. Never buy a brick and mortar business more than 10 to 15 miles from where you live unless you plan to move there. That is Cliff Ennico's rigid and inflexible rule. If you do not understand the community, you do not know what you're buying into. Don't look just at past performance. Anticipate the future risks. New competitors any new businesses moving into town that are going to compete with this business. Demographic and legal changes. Digital alternatives. How is the business coping with the move to digital? After the pandemic, we're going to be seeing a lot more things done digitally than with brick and mortar. How is this business positioned to deal with that. Line up a good accountant and a good lawyer before you buy a business. It's better to buy, if you are a purchaser, it's better to buy a business's assets rather than stock, unless there are key assets that cannot legally be transferred, in which case you're going to have to buy the stock, and make sure the seller, gives you some very tight representations and warranties, warranting the quality of each one of the balance sheet items you're buying. Watch out for bulk sales laws and transferee liability for taxes, especially sales taxes. That's a nasty surprise. I can't tell you how many times a client goes to the closing and discovers that there's a sales tax bill they weren't expecting. That can be a deal killer. And then last but not least, do not buy a web-based business unless you or a partner have SEO and web marketing experience and can deal with the inevitable algorithm changes that happens when a business is dependent upon Google for 90% of its sales. So we'll take questions now. I think I've left a few minutes left for questions and answers today. I know I had to race through a bunch of stuff. Let's take a look at the chat room. First of all, Bob, do you want to coordinate
Yeah,
this?
that's great. Thanks, Cliff. A lot of information packed into there for people, and we will use the last 5 minutes or so here to take as many questions as we can. And if you want to submit a question for Cliff, as I said before, please submit it via the chat feature, and we'll take as many as we can until the top of the hour. Cliff, we do have a question here from John. Is a seller legally required to disclose all financial documentation and information? And is there anything that they are not legally bound to disclose?
Okay. The short answer is, if you request it, they must give it. When I do an a purchase and sale agreement, I always put in a clause that says that as part of the due diligence, the seller will disclose at least the last 3 years of income, sales and use taxes, and payroll taxes. Those are the 3 things. If they do not disclose that, then something is wrong and you walk from the deal. If you request it and it's in the purchase and sale agreement, they must disclose it by law, but otherwise they are not required to disclose it. Now, of course, if they don't disclose key information like that, you're not going to buy the business. So they are going to disclose that information like that. The bottom line is, when you do a purchase and sale agreement, you want the seller representations and warranties to be as tight as possible. And especially if you're buying stock, it's not uncommon for stock purchase agreements to be 50 or 60 pages long because of all the representations and warranties. So for example, cash, the seller has enough cash to maintain the business for at least 30 days after the closing. Accounts receivable, the seller only has so much accounts receivables and none of them are more than 90 days old. You want representations and warranties for each line item on the balance sheet, and hold the seller's feet to the fire. If the seller does not represent and warrant that something is going to be the case after the closing, then they are off the hook. You cannot sue them for that. So you want the representations and warranties to be as detailed as possible, and that's why you need a good attorney to help you with that. It's not like buying a business where there are laws requiring the seller to make certain disclosures. You're the one who's got to make sure that the seller's feet is held to the fire that way. This is very much a buyer beware universe.
Okay, that's great. We have a second question from Edward. Can I have my business evaluated so I know what it's worth if I'd like to sell it?
Certainly, the answer is yes. This is where a business broker can actually be very helpful. And there are some business brokers that will do this. They will do an evaluation. They will charge a fee for that, of course, which you have to pay. That comes out of your pocket. That doesn't come out of the proceeds of sale. But there are a lot of business brokers will do that for you. There are also valuation firms. They tend to be very expensive, only because they're certifying what they're doing. But if you ask politely, there are a lot of business valuation firms and a lot of CPA firms too, that will do a seat of the pants valuation. They'll do just a quick interview. They won't certify anything. They won't say this is accurate or complete, but at least it'll give you some idea of what the business is worth. And it might be worth paying a few $1,000s to get that information. Again, a lot of CPAs will not do this. CPAs are not generally licensed to value businesses. If you go online and you search for business valuation professional and then your state, So Business Valuation Professional New York, Business Valuation Professional CT, you will get a list of people and firms that do this kind of work, and just make a few calls and just let them know you don't really want to hold their feet to the fire. This is not an IRS valuation. It's just that you want to get a rough idea of what the valuation is worth. Could they do a quick seat of the pants valuation for you? And many of them will do it, especially the smaller firms will do that for you. So that's a good way to get, at least some reliable information, with the understanding, of course, that a buyer will not necessarily be bound by that. I mean, if they're really worried about, how COVID is going to impact this business for the long term, even the best valuation, won't be enough to satisfy them.
Cliff, well, we've got very little time left, but I'll give you 30 seconds to answer the last one here, which is, what is the most common mistake that buyers typically make when buying a business?
The most typical mistake is not getting a good lawyer and a good accountant to help them. People don't like paying legal and accounting fees, and I totally get that. But this is where it's best to be. You can be penny wise and pound foolish. I have had clients come to me with major businesses that have just major problems, a lot of which should have been addressed when they bought the business up front, especially with franchise businesses. A lot of people will say, "Oh, it's a franchise; it's going to be okay. The franchise knows what it's doing. I'm not going to hire an attorney to look at the franchise documents. I feel comfortable doing this, so I'm just going to go ahead, and the franchise will look out for me." That is a major, major mistake. Always get a good accountant and a good lawyer. Believe me, it's worth the money you pay these people to do the diligence correctly, and make sure you're not buying a dog with fleas that's going to drop dead on you 6 months after you close.
Okay, well said. Fortunately, we're out of time today, so that's all the questions we have, or all the time we have for questions. Just a reminder that the webinar has been recorded, and you'll be able to access that recording from our website, fairfieldcounty.score.org, within the next 48 hours or so. Our next webinar is tomorrow, Wednesday at noon, and the topic is Digital Marketing Strategy for 2021 and Beyond, with Susan Catalano and Robert Clark. And again, if you would like to take advantage of individual counseling, you can go to the Request a Mentor link on our website. And if I could ask you to please fill out your evaluations, that would be very helpful. So on behalf of SCORE, thank you everyone for attending today. And in closing, Cliff, great presentation. Thanks again, and stay well, everyone, and have a nice day.